So what happens is with the limited company, if you buy the car as a company, so the company contracts for the car, bills in the company's name, company owns it, and then it gives it to you. And as always in these shows, we're presuming you're a sort of director and an owner, a shareholder of a small UK limited company. Then as an employee, the employee tax laws kick in, and it says the minute that car is available to you, you would have to pay what's known as a benefit in kind tax on that car because it's available to use privately. Now, if you Google it on HMRC, it's probably going to say to you, oh, only, if it's available privately. But if you look at the case law and HMRC's interpretation of that, it's very, very wide. The minute it's available to sit on your drive all the time and it's accessible to you, it's going to be available. If there was an emergency and there's two cars parked on the drive and yours is the one at the back of the drive and you had to go to the hospital, you're going to get in it. Therefore, it's available privately. So yes, you might have heard of these things called pool cars, and we've done a few shows on pool cars before, and these things are available. In this show, I'm just talking about generally, for most people, you're going to want to commute to and from the office or to and from your workplace, and you're going to be having it on your drive. Therefore, it's going to be available for private use. So that's what we're talking about. And when that occurs, two things happen. You get kind of two tax bills, one for you personally as the owner, and that's based on a list price. And that's what they call taxable benefit. You get a form every year currently called a P11D that tells you you've been taxed on this stuff. And you generally, if you're doing any sort of income, are going to end up paying personal tax on that bill. And that's whatever that rate is. So if you pay, basic rate tax, it's going to be at 20%. If you're a higher rate taxpayer, so your income's over around 50K a year, you're going to pay 40%. So the other thing that impacts is because it's taxable income. If you imagine, and we've talked about it in previous shows, if you sort of stack up all of your income like a stack of books, you can go up to that 50K line without paying any, real big tax. Once you get over around 50K, it's slightly more than 50K, but once you get over there, you have to start paying 40% tax, or on dividends, you're going to start paying 33.75. It's a massive jump. But because this taxable benefit's stacked in there as well, you're actually reducing the amount of band you have available for that cheap dividends or that cheap other income. So it does have an effect on you personally. So big cars with big taxable benefits end up eating a lot of that band as well as costing you a lot of tax. And then the bigger bill often is the one that's actually the company produces on top. So when the company provides it to you, it has to pay a special class of national insurance at 15% on that provision of that benefit.